WeWork wasn't priced like a real estate company. It was priced like a story so powerful it carried the company to a private valuation of $47 billion. And then, almost overnight, the spell broke. Not because people stopped needing offices, but because investors finally asked a brutal question. What exactly are we buying? Here's the clean version of the business model. WeWork would sign long-term leases on buildings, spend heavily to renovate them, and then sell short-term memberships, flexible desks, private offices, and enterprise suites. That mismatch is the entire drama. Long commitments on one side, short commitments on the other. In good times, the spread looks like growth. In bad times, it looks like a trap. The illusion worked because it didn't sound like real estate. It sounded like software. Community, platform, tech-enabled, and with enough capital behind it, the company could expand fast enough to make the narrative feel true. SoftBank poured money in, and the valuation climbed. But a valuation is not a verdict. It's a bet on what happens next. In August 2019, WeWork filed publicly for an initial public offering. And that is where the story collided with paperwork. The filing laid out losses, cash burn, and risk factors in black and white. It also pulled the curtain back on governance, how much control the founder held, and how decisions were structured. The market didn't hate the concept of flexible office space. The market hated uncertainty disguised as certainty. And it wasn't just the income statement. The IPO documents drew attention to conflicts and related deals that felt shocking in writing, even if they were technically allowed. The founder had owned buildings that were leased back to WeWork. There were loans. And there was even a widely criticized trademark transaction where the company paid for rights to the word "we," only to unwind it after backlash. None of those details alone killed WeWork, but together they changed one thing that matters more than hype: trust. And trust collapses fastest when incentives are misaligned. A long lease is basically a fixed debt payment. A month-to-month membership is basically optional. That gap can be hidden by growth, but it can't be erased by optimism. Once the S1 was public, the conversation shifted. Journalists and analysts weren't debating vibes. They were debating fundamentals. How expensive the lease obligations were, how much it cost to acquire and retain members, and how long it would take to reach profitability. Reports suggested the IPO valuation could be cut dramatically from the private market peak. The question became simple. If growth slows, what happens to the fixed costs? Then came the next collapse: confidence. In September 2019, Adam Neumann agreed to step down as CEO after intense scrutiny and pressure. WeWork tried to reset the narrative with new leadership, but the calendar was unforgiving. The IPO was delayed, and by the end of that month, the company withdrew its IPO filing. At that point, the business wasn't just facing a bad headline, it was facing a liquidity problem. WeWork needed money to keep operating at its pace. And in October 2019, SoftBank stepped in with a rescue package worth $9.5 billion. New financing, accelerated funding, and a tender offer for existing shares. The deal effectively transferred control and ended the myth that WeWork could float on charisma alone. And that's the real lesson. WeWork didn't fail because people didn't want co-working. It failed because the company's cost structure demanded perfection. Constant growth, constant occupancy, constant belief. When your model relies on confidence, the moment confidence drops, everything gets more expensive. Capital, debt, partnerships, and time. If you build a company that signs long-term obligations while selling short-term promises, you must be obsessed with downside. If you market yourself as tech while carrying real estate risk, you must prove it in the numbers. And if governance is built to protect a narrative instead of protect shareholders, the market will price that risk the moment it's forced to read the fine print. So when you hear 47 billion, don't think of it as a peak. Think of it as a warning label. Because in business, the most dangerous illusion is not believing your own story. It's building a system that only survives if everyone else keeps believing it. If you're building anything, the same math applies. Narrative is leverage, but structure is survival. If you want more business stories like this, where power, incentives, and structure decide who wins and who collapses, subscribe and turn on notifications. The next episode will change how you see the word valuation.